So, hello, welcome everyone. My name is Gershon Margolis. I'm the founder of Imperial Advisory, and thank you for joining our webinar today. Imperial Advisory is a team of fractional CFOs. In large organizations, the CFO is often one of the CEO's most trusted advisors. For companies not quite at the size where they need a full-time CFO, using a fractional CFO gives them the same sort of strategic guidance and advantage for as much time a week or a month as they need. We pick up where accounting and bookkeeping department leaves off, and sometimes we'll even serve as a second set of hands for an existing CFO. Several of our CFOs have held other C-suite roles throughout their careers, like CEO or COO. Most of our CFOs have over 30 years of experience. In addition to being the day-to-day CFO, we also get involved in M&A, providing M&A advice and assisting in the decision-making process across many aspects of a company. One of the things that there's a lot of things we get involved in. We get involved in helping the business run. So there's the financial aspect, and then there's all the things that we kind of uncover, things that impact the financials, and we often get pulled into other things. And one of those things is partnership disputes. So we've been involved in helping partners, for example, either make peace or figure out how to move on without each other. And one of the things that I think is important in any business is, I guess let me say, when dealing with partnership disputes, there's often, buy, sells, different types of mechanisms that exist in order to get a partner out. And those buy sells are often funded with life insurance. Anyway, long story short, we have a wonderful guest here today, David Mosenson, who, besides for his day-to-day work on dealing with a variety of financial planning and insurance related matters, he also has a specialty in helping businesses that own life insurance policies they no longer need, dispose of those policies. So what do you do with that policy if the person is alive and well, but the company no longer needs it? Anyway, that's, I guess, my basic introduction to the topic. And now I will turn it over to Dave. Take it away.
Hey, Gershon. Thanks a lot. Appreciate the opportunity. So let me just give a quick background on our company. J&G Associates, we actually just celebrated our 40th year in business. We are a virtual, global, family-owned business, doing business all across the United States and internationally. My daughter's our CEO and runs the company out of Australia. Our attorneys that we work with in-house are in Chicago, our planning department's out of Philadelphia, and then we have private equity people that are dispersed out of California, and then we have staff that's basically spread out over the East Coast. And what we are is we provide very sophisticated life insurance, estate tax, and general planning in two different verticals. My concentration is working with companies, with individuals or families that have a minimum net worth of $25 million up to the family office space and the billionaire family. And the other vertical that our office works with is for those clients who are under $25 million net worth. The world of corporate-owned life insurance, and when it's not necessary, it's just one segment of a much larger market. That market's known as what they call settlements in the life insurance industry. And even if you haven't heard about it and you don't know about it, you may know something about it because you may see the ads on TV from Coventry trying to find people who have life insurance policies who do not need them or do not want them, and they're going to cash it in. So what Coventry is one of a host of buyers of life insurance policies when people don't need them. And what it is if you think of it this way, there's a secondary market that will buy life insurance policies as an investment. So basically the buyers are hedge funds, retirement plans, such as in New York State, Teachers Association. And what they'll do is they'll allocate $1 billion or a certain amount of money, and they will buy up a significant amount of life insurance policies. And through the process, what they do is now they have an asset that is an uncorrelated asset to the market, and they basically have an idea of what that's going to return based on the way the company, based on the way they're buying policies and they're pricing the policies. Yeah. So do you want to go through like the process of what it is, Gershon? How would you like to?
Sure.
Yeah. Okay. So basically what it is while the topic today is dealing with corporate owned life insurance policies and when they may not be needed, let's just go to the broader concept of, if you're an individual or a corporation, what the buyers are looking for is they're looking for policies on people who are typically age 70 and older, and people who have changed, had a change in their medical situation. By that I mean is the company's taken out a key man policy on one of the individuals in the company. They're age 55 and they're perfectly healthy. Now they're age 70, they're not as healthy, and he's leaving the company. What there is there's an arbitrage in there, because when he took the policy out, statistically, if he was a preferred or a standard or a super preferred rating, his life expectancy is X. Let's call it 90. Now he's 15 years older, he's age 70, and basically what it is now, because he's sick, he's had cancer, he's got diabetes, he's overweight, or a myriad of other medical conditions, his life expectancy is no longer 90. His life expectancy might be 82, 83, 84. So there's this arbitrage where you have a policy that was priced for someone to live in their 90s, and now he statistically is going to die at age 85. So that policy has value. That buyer is going to be buying that death benefit, whether it's 500,000, $1 million, $10 million. And when that client dies, they're going to get the money. So what they're able to do is they calculate, okay, statistically, that person's going to die in 9 years. We're going to get X dollars. It's going to cost us in the way of premium, X dollars over the years. We want to make 14% rate of return on the money, whatever. What can we buy that policy for? So a lot of people, don't know about this, and so basically if you're the company, typically you have a partner and you don't need the life insurance anymore. What you do is either, if it's a term policy, you let it lapse. If it's a permanent life insurance policy, you surrender it for the cash surrender value. More often than not, if there is this arbitrage where a person had his health change, we're able to get significantly greater value for that client by selling it in the secondary market.
I have a question. What happens if it goes the other way? What if the person was overweight and unhealthy when you bought the policy at 55, and now they're much healthier at 70? Their life expectancy went up. Is there anything, so now the policy should, I guess my question is, does the company have an incentive to buy that policy from you?
When you say the company, the insurance company?
Insurance company.
No, insurance company, well, I shouldn't say, it's just actually they're starting to get into the market. But no, but typically what will happen if they have a good insurance agent and their health has improved, there's one of two things. You can sometimes go back to the company and say, hey, his health has improved. Can we improve on the pricing? Or that company says no, and you go out into the market and you buy a new policy with a better rate.
And you just let that first one lapse.
Correct. Or yeah, and if it's got cash surrender value, what you can do is what they call a 1035 exchange, where the cash goes from the existing policy into the new policy tax-free, and you're carrying your basis from the old contract into the new contract.
Got it. Interesting.
And the process of selling that life insurance policy it's different than buying a life insurance policy. Buying a life insurance policy, I will say, is somewhat intrusive sometimes, because you need medicals, you've got to give blood or whatever, even though in today's world, because of COVID, we're typically able to get in some situations, up to $10 million on an individual without any medical. if the stars line up right. Because what happened is, and I know this is deviating, but during COVID, or pre-COVID, if you wanted to buy life insurance policy, you required an exam and the doctor had to come to the house. Well, who was letting a doctor come into their home during COVID? So basically what happened is the insurance companies had to go to what they call analytical underwriting, which is just a different way of gathering a lot of the information to try to be able to get policies issued without that medical exam. But so the process of selling a policy is, I'm going to say, rather simple. So basically what it is whether you're an individual or you are a company, and you have a policy that you've got that scenario where someone was younger, they're now older, their health has changed, you don't need that policy anymore, and you want to explore the secondary market. So basically what it is, there's a document that we become, in essence, the broker to look to sell that contract. And basically what it is we need a couple of things. One, we need to obtain the current medical records from the client from all their doctors. There's no insurance exam needed. So we get the medical records. Then what we do is we then get an illustration from the existing insurance carrier that is basically keeping that, what would be the premium to keep that policy in force either to age 100 or 105. And that depends upon the contract in the company. What we then do is once we get the medical records, we're sending that out to what they call a life expectancy company. So if I'm working with you on getting new life insurance, I'm trying to make you as healthy as I can to get the best rate. Under this scenario, because we're looking to sell it, we're trying to make you as sick as possible with as short a life expectancy, because the shorter the life expectancy, the higher the amount of money we were able to get. So once we get that life expectancy, we now have how long statistically a medical analysis firm thinks you're going to live. We now have the pricing to keep that policy in force. We then bundle that up and then we send it out to firms that are looking to buy the policies. And it actually goes into an auction process. So we'll then go out to companies that have access to funders, and we could end up with 20 different organizations looking at that policy to see if it fits into their, and would be a good fit for their portfolio. So it's sort of like a real estate transaction. I've got a building, I want to sell the building, I give it to a broker, they send it out there, and then people come and start to bid on that. And then we typically will then sell that policy to the highest bidder. What people sometimes say is, well, wait a minute, I don't want Julio or David or Gershon down the block owning a policy on my life. That's not it. It's all redacted. It's owned by funds, hedge funds, and like I said, retirement plans. And then what it is whatever that profit, so if your policy had an existing cash surrender of, let's say, 100,000, and now you're getting $400,000, it's a better investment than just cashing the policy in.
Got it. Now, how big a policy does it need to be to get 20 people to an auction?
Well, typically what they're looking for is somewhere a minimum amount of $500,000 of death benefit up to whatever. When there will be situations where we can find buyers for 100,000, 200, 300,000, but you may not get 20 buyers that are looking at that.
Interesting.
Also, when you think about it, think of yourself as a buyer, okay? Because what you're doing is you're using up capital. So now I have a $10 million policy, and I'm going to buy that policy from the client. So I'm going to give them 300,000, 500,000, $1 million up front. Then I'm going to pay the premiums. They're not looking for people who have life expectancies of 18 and 20 years. They don't want to tie up capital with with that long of a return. So what they're typically looking for is maybe, they love 5-year returns. Okay. But, somewhere less than, like, let's say 10 years, could be a little bit longer under certain circumstances.
Got it. Now, is there a reason why this is specifically a corporate issue? Like, are they looking specifically to buy from companies, or anyone can sell
No, it's, yeah, anybody
into
can
this
sell it.
market?
Yeah, a lot of time, yeah. And actually, there are more policies sold in the individual markets than on the corporate markets. You know, think of your aunt, your uncle, yourself, you know, so, you know, you're 65 years old, you've worked your whole life, you sold your company, you've got $10 million, and now you don't need that $1 million life insurance policy anymore. You know, and you say, you know what, my kids are gonna have enough, I don't have a state tax problem, I'm gonna sell it. A lot of, or, you know, and, you know, a lot of other times people are selling it because they need money. You know, they don't have enough money to retire on. So think of it just as an asset that's no longer needed or fits or is better served by having cash.
Got it. Now, what happens if you go and you do the research and it turns out that there's no value to this policy? Does the seller end up paying a bunch of fees
So
to
no,
you or to any of the medical
if
firms?
yeah, if the transaction isn't completed, it doesn't cost the client anything.
Does the medical firm, do you pay the medical firm, or does the medical firm only charge when the transaction happens?
No. There are fees up front, but unless the deal is completed, there's no fees to the client. Either
Got it.
ourselves or the potential buy, the broker that we go through, the intermediary, is paying for those. Because, you know, like to get that life expectancy, you know, and you need to do that. You need the medical records and you need the life expectancy. So there are no, you know, if the transaction is not completed, the client doesn't have any fees they're paying.
Got it. Okay, let's see if this is similar to my question. We have a question. Does the seller pay the broker, or are there fees from the insurance company? What cost does the seller incur? I assume that's if a transaction does go through. That's from Ken
Okay.
Grossman on LinkedIn.
Okay, so if the transaction goes through, first of all, it's not necessarily an insurance company. Okay, the insurance companies are not. It's just sort of, insurance companies are not buying back their policies. And I'm going to use that as a blanket statement, even though some insurance companies, under a couple of circumstances, have started to actually get into it. But let's not think of it. Think of it as a hedge fund or, you know, a retirement plan that's buying the contract. So what it is there's a gross offer, okay, that's made, and then from that gross offer comes the commissions. Commissions are regulated by every state. Every state will, you know, has a certain limit on what can be charged as a maximum.
And that's even though there's only 6,000 policies a year sold. Every state has got their own rules about this.
The insurance industry,
Wow.
yeah, the insurance industry and life insurance is not nationally governed. It's governed by each state. So we deal with 52 different regulatory organizations.
Okay. So
Nuts.
who are the remaining two? DC and Puerto Rico?
I assume so, yeah.
Okay.
Yeah, everybody 50 of them, yeah.
Oh,
Yeah, no,
Maybe-
each state has their own regulatory, you know, and New York is by far the strictest.
uh-huh.
If you want to get into a discussion, you know, if we want to just broaden this a little bit, when we're working with our clients and they need to buy life insurance, we are actually trying to set it up so we can buy it out of state. The reason I say that is due to this New York State Insurance Department, the number of companies that do business in New York and the products that they have to sell in New York is significantly less than if we're doing business outside New York. So a lot of times what we will do for our clients so that we can get better products and have more companies in the mix, so to speak, and this is the selling of new policies, we will do trusts outside of New York. And if you're doing a trust outside of New York, that means I can then say, Gershon, okay, we've got company XYZ in New York, but now we have company XYZ ABC, and we've got a lot more different and better products outside New York.
Got it. All right, we got a question here from Ken. Does this work with term insurance?
Yes, here's where, and that's actually a great question, because what will happen is a lot of people will buy 10, 15, 20-year term. And at the end of that term, that low level premium is going to become unaffordable. if it's convertible, because the buyers of the policies only want to buy permanent insurance policies, they will buy that term policy. So I'll give you an example. So we actually just had a situation that we were brought into. It was a $10 million policy owned by a company on their chief executive, and the company was having financial difficulty. He had ALS. Okay. They needed money badly. They were selling this $10 million term policy in the secondary market. They were offered $5.5 million for this policy.
Was
So
it fully paid then?
Well, what it was a term policy.
Oh,
So
it was
what
a term
happens is when the firm buys that term policy, they will actually convert it to a permanent policy, because they don't want to buy a policy that will lapse. Because they
Right.
know if I'm buying one policy, that person could die tomorrow, could live to be 100. But if I'm buying 5,000 policies, it's all going to come out in the wash. I can't tell you who's going to die when, but I can tell you, if I got someone who's 78, I can tell you when statistically that group will die. So, actuarially it works out. But yeah, so term insurance policies are one of the biggest things that we do, because like I said, you're 55, you bought a 15-year term, you're now 70, your health has changed, you can't afford the policy, you can't afford the conversion, we'll sell that in the secondary market.
Interesting. So can you give us an example of just like walk through a transaction? So you have a 10.
Yes, so I'll give you a couple transactions. So we had a client that we had done a lot of estate tax planning for about 15 years ago. At that time, they were 73 and 72. They were both issued at a preferred non-smoker rate, which was the best rate back then. Okay. It was actually like about $11.5 million of what they called survivorship. So it insured both of them. Zoom ahead to today with the estate tax plan that we did and just some other things that happened. They don't need that $11.5 million life insurance policy that was costing them about $232,000 a year. So the policy had a cash value of about $400,000. And he called me up and he said, David, we don't want the policy anymore. My sons have plenty of money. We don't think we need it from an estate tax planning standpoint. So they were now 88 and 87. He's had 2 heart attacks, and she had cancer twice. Okay. So now when we originally took the policy out, that 73 and 72-year-old had a life expectancy where, since it's a survivorship policy, which pays off after the second death, that second person was statistically supposed to live to be 95. Now, at 88 and 87, statistically, the combined joint life expectancy was about 4.5 years. So it's going to be 92. So instead of 97, okay, or 95, 97, whatever it was, it's now 92. A funder came in and said, look, we will buy that policy for $1.8 million. So instead of the buyer just cashing the policy in and getting their $400,000, they got the 1.8. They took the 1.8 million.
So I'm curious, what is the cost of capital of these buyers? I would have thought that you would pay 4 or 5 million for that, even if you were looking for 20-30% a year.
It depends. What they're doing is they add buffers in there. So first of all, they're looking to make somewhere, and again, it depends where interest rate, 14 to 16% rate of return on their money.
Okay.
Then let's assume, while statistically this couple may have had a 4-year life expectancy, they're adding 1. So now it's 7 years, let's say.
Okay.
So now they have to pay $450,000 a year for 7 years, which is, let's call it $4 million. They've given $1.8 million up front. They want to earn 16% rate of bingo. That's how it ends up.
Got it. Okay. I also wasn't thinking about the fact they're going to keep paying premiums.
Yeah.
So that even with 5 years, that adds $1 million, and if it's longer, then that adds even more. Okay. Interesting.
and then once in a while we'll come across just that small, and we did this for a friend of ours, and our good old buddy Jeff Weiner, had a good friend who had a $1 million term policy. And he's been in the hospital, I can't tell you, 20 times with heart issues. His term policy was going from, was coming into that last year, was coming into going from $1,000 to about $20,000 a year, and he just couldn't afford it. So he was just going to let that policy lapse. And Jeff asked us to get involved, and we actually sold that policy for $130,000. And to this gentleman, getting $130,000 for something that he thought was worthless, changed his life.
Got it. Helping the small guy.
Now in the corporate world, okay. So I'll give you an example of a case that we did years ago. What it was a company was actually in bankruptcy, and it's amazing how many bankruptcy lawyers don't even think about this or are not aware of this. But when you think of it, and you've got a company that's either in bankruptcy, okay, and now you've got 100 creditors or whatever, they don't want to own a life insurance policy. So typically, what happens is the policy is just canceled. For bankruptcy attorneys who we get involved with, say, you know what, there's that could, depending upon the situation of the insured, if there's that arbitrage, there's significant wealth there. So we actually had a client that this was pre-9/11, right, like post 9/11. It was a company, one of the partners had a stroke. He was in a nursing home. They had a $10 million policy on this gentleman, and they were paying whatever they were paying for this policy. And the cash surrender value was, let's say, $100,000. It was really low. And the company went into bankruptcy. We got in touch with the bankruptcy lawyer, the bankruptcy trustee. And we told him, we said, what are you going to do with this policy? He said, I'm going to cash it in. I'm going to get my $100,000 to it, whatever the cash. I said, well, do you realize what you're doing? You have someone who's had a stroke. He's in a nursing home. He's not going to live 3 years, 5 years, 6 years. That $10 million policy has substantial worth in the secondary market. And it said, no, I never even heard of this. And basically, we ended up selling that policy for about $2.5 million. That was then dispersed to the creditors.
Wow. So this sounds like a wonderful setup. My question is there a way for this all to blow up? Are there stories of how things don't work out, or is it always?
The definition of not working out is you are the buyer, and you've calculated that person is going to statistically die in 7 years, and you've made your pricing on that, and he lives 20 years.
Got it. But if you're buying a portfolio, you don't have to worry. If
you don't worry about. Yeah, I mean, I can't tell you how many times. And look, there are times that people are just so stressed financially that they need to sell the policy. So we actually had a case last year of one of my it was one of my first clients. It was a family. Unfortunately, they had some financial, and the father had this, I think it was about $500,000 policy. No, actually, it was less. I'm sure it was about $100,000 policy. And, really finding a buyer for that. He was 96 years old. Family had no money. He needed round-the-clock care at home. And they actually asked us, can you find a buyer? And I said, look, based on the medical information, your dad is going to pass away in the next year. And it was, let's say, called $18,000 to keep the policy in force. They said, we understand that, but we have no way to get $18,000. Can you sell the policy? Can you find us a buyer? We got lucky. We found a buyer for $45,000. Okay. So now to the family, they got $45,000, which meant they were able to give their dad round-the-clock care for 10 months. 4 months, whatever it was. And he actually died a month later. So, had they kept it, they would have got the $100,000 of the death benefit. But that was a situation where it didn't matter. They needed to sell the policy.
Got it.
So we're, right now with what's going on, places where it makes, where there is the need to look at this is a lot in the estate planning markets. Because of, right now your exemption, where people can pass roughly 12.9 million, about $13 million, 26 million for a family. So a lot of people bought second to die years and years ago to cover the estate tax when the exemption was less. Those people are realizing, hey, we don't need the insurance. Is there a potential sale? And it's become a lot more like, because Coventry does a lot of advertising about buying policies. People are coming a little bit more aware of it, but yeah, the marketplace is really small. Like you said, if you think about all the life insurance policies that have ever been sold, okay, and you think about all the life insurance agents and financial advisors who could be selling policies, which there's about 175,000 life insurance agents in the country, and then you think that really in the retail market, only about 6,000 policies are sold per year. It is something that, is this hidden gem for people to be aware of.
Got it. Now, how does, well, actually, I have a question about interest rates, but I want to just ask a question about what you just said. You said in the retail market, there are only 6,000. Do you mean resale market, or do you mean retail
No, for the
versus
retail
corporate?
market, because what's happening is I'm a hedge fund and I'm buying up 1,000 policies, and now I got my portfolio that's earning 8% rate of return. Think of it as a collateralized mortgage obligation. I am now selling that to the next buyer, and then they may take that portfolio, add $1 billion to it, and expand it. So that's why I said, and I don't consider that the retail market.
Got it. So retail is when they're buying it from the original purchaser, whether it's a company or an individual that originally purchased the policy. Correct. And then when a hedge fund sells it to another hedge fund, that's what you call the tertiary market.
Yeah,
So how do interest rates impact this business? Have you seen prices go down due to interest rates going up?
It's really weird because there are other factors that get into it. But yeah, if interest rates are going, if interest rates are going up, and I'm looking to make more money, my 14% instead of 6%, then my offering is going to go down. It's no different than, again, think of it as a piece of real estate.
Right.
Higher interest rates, lower price, because I've got to make my ROR on my investment.
Right. So now what I was just thinking, I haven't done the math, but the value of the policy, the present value of the final policy payout is going to be lower with higher interest rates, but the present value of the individual payments, which the buyer is responsible to make, is also lower.
Well, it could
the
be
cost, if you will.
Well, your premiums are going to be your premiums. So you have to think of it if higher interest rates, because a lot of times, they may be leveraging the portfolio's investment. So let's assume that, they're going to put in $700 million and then they're going to borrow 300 million. Okay. So the higher the interest rates, because it's their borrowing capital. And
okay. Interesting. All right. Some good food for thought.
Yeah,
all right.
and then the other thing that I will tell you about is, it's full disclosure, because here in New York State, when you're selling a policy, I mean, it's a closing. I mean, the document is 70 pages long. Commissions and expenses are disclosed. Also, all of the offers from all of the funds are disclosed. So we actually recently had one where we had two funds that really wanted to buy this policy. So the offer started at about $400,000 and ended up at about $800,000 or $900,000. But at the point that it got to about $750,000, they actually went up $1,000 or $2,000 more than each other. And then I just said, okay, Friday is, Friday, 3 o'clock, last offer wins. But they were literally going up 1,000, because you're trying to buy it as low as possible,
Right.
But the other thing, what I was saying about the commissions. So when you buy a life insurance policy, okay, that's regulated. Commissions are commissions. There is no negotiation. In the life settlement market, there is a negotiation. So one of the issues that arose in that $10.5 million, that $10 million policy on the ALS, the person that had ALS, the way I got involved was the attorney called us and said, David, I got to ask you a question. Here's the transaction. Here's the discussion we're having. The broker is taking a $600,000 commission. My comment to them was, do you understand the whole transaction here? He said, yeah, I understand this transaction, that we're going to be selling the term insurance policy to the fund, and we're going to get $5.5 million. I said, yeah, but I'm telling you, your broker is acting like a pig. I said, there's no other way. Number one, he's taking the maximum commission that's available by law. Okay, so he's taking, but what you don't know is because it's a term policy, when that policy is sold to the fund, that fund is converting that $10 million policy, which probably has about $1 million commission to it. He's making that commission also. So on this transaction, your fund, your company is getting $5 million, $5.5 million. The broker's making $1.6 million.
It's a good business. I should go into that business.
Yeah. And as it turned out, when they found out what was going on, they didn't do the transaction with that broker.
Got it. Now, did he have to disclose that, or since that was another transaction?
Well, the sale of the policy discloses the $600,000. The conversion commission that he makes is not a party to that transaction. That's between him and the fund.
Got it. All right, we got a question from LinkedIn from AJ. How are proceeds from settlements taxed? Can taxes be more favorable if the seller elects to leave a smaller death benefit to beneficiaries instead of taking cash today?
Well, there's a couple things. So relative, and I knew someone was going to come up with this one. So, so basically what it is on the taxation, okay, the amount up to basis, which is the premium you've paid in, okay, is tax-free. So if I buy a policy, and let's call it a universal life or permanent, okay, and I put in $25,000 a year for 20 years, and it's $500,000, and my cash surrender value is $100,000, and I sell it for $500,000. Okay, so I've got that sale price is equal to my basis, tax-free. If I'm getting more amounts received in excess of the tax basis, okay, up to the cash surrender value is taxed as ordinary income. Anything above that, I have a policy, the cash value is $200,000, okay, and I'm getting and I'm getting $200,000, okay, okay, so that go in that's ordinary rates, but above that is long-term capital gains.
If you wait until the person passes, then there's no tax at all, right?
Correct. Yeah. So look, the idea of a life insurance settlement is a last resort. Okay. We're only doing this if it's a last resort or you don't need the asset. It's not something, if you can, if we can help the client figure out a way to maintain the policy, you're always better off keeping the policy. I mean, we actually had a situation years ago where it was a $4 million policy on a woman, and she statistically was supposed to live to be 95. So when the insurance agent designed the policy, they had designed it for her to live to be 92. So now she's 93. You've got a $4 million policy. There's no more cash in the policy, and the premium is $400,000 a year. So they were looking to try to sell that policy. So it was a $4 million policy. And I don't remember whether they were able to get $1.5 million or whatever it was, but it certainly was not $4 million. In doing the work with the client, we found out that they didn't have the cash to be paying $400,000 a year, but they had art. So basically what they did is they started to sell off some of the pieces of art to keep the policy in force. And then when they sold off, I think it was 2 years worth of art, and they had no more art to sell, and she was sick, what they basically did is they went out to family members and pooled the premium from family members and, paid them, let's call it an exorbitant interest rate on their money to maintain it. Because think of it, somebody who's in their 90 years, in their 90s, do you really want to get rid of a life insurance policy? I mean, yes, they could live to be 100, 102, but, more likely than not, they're not going to.
Right. I hear. Interesting. All right. Any final questions? All right. Dave, anything you want to add before we wind down?
No, I appreciate the opportunity, to be on the show. And it's always a pleasure seeing you.
Likewise. All right. Thank you everyone for joining. We have a few people on LinkedIn. We have some people from our team on here. And thank you, Dave.
You're welcome. Talk to you soon.
We'll talk soon.